Hello and welcome. I am Siddharth Zarabi and you're watching Business Today Television. With me today to discuss their quarterly performance, the second quarter, is Joseph Anantharaju, the Executive Vice Chairman and CEO of Product Engineering Services at Happiest Minds Technologies. Also with us, Venkatraman, Narayanan, the Managing Director and CFO. Welcome, gentlemen. The stocks under a bit of a pressure because profitability is a bit down. What dented profitability in the quarter under review?
Essentially, if you look at it on a quarter-on-quarter basis, we had already said to the markets last quarter itself that we would be taking pay increases, the impact of which will be felt this quarter. And so we have gone about doing that. We have not only done that, we have paid out committed variable pay. We've also onboarded all the freshers that we had given offers to. So in fact, if you compare us to many of the other industry participants, we have gone ahead, given pay increases. Our net headcount has increased by 235 people. Our utilization has obviously taken a slight bit of a dent. One is because of the campus joiners that we had joining us, and the committed variable pay payment. All of this has had an impact on the profitability, about 3.5%, half of which has been recovered through revenue growth and certain amount of other income. So on the profitability front, we are within the guidance target of 22 to 24% on EBITDA. And we have also corrected, or we have updated our guidance, revenue guidance, because we had given a guidance of 25% for the year, which was, there was no distinction called out between organic and inorganic growth because we had a couple of good names, one large name in the pipeline, in which we are seeing some delays in that acquisition. So we have come back to the markets to correct the guidance for the next quarter. And we have now said that on an organic basis, we go 12% for the rest of the year. And if we should go ahead and do any of the acquisitions that we are pursuing, growth that will come out will be on top of the 12% that we are currently guiding the markets for. So maybe parts of these have not been taken too kindly, and which is why you're seeing the stock under pressure. But when they do see, when the markets do see that we are here building a fundamentally strong company and committed to that $1 billion aspirational target that we have set up for ourselves by 2031, I'm sure things will change. Also, in comparison, we have grown 4% in rupee terms, 3.6% in constant currency terms. Year over year, half year over half year, we have grown our revenues at 12.7% in constant currency terms, which I think is a no mean achievement when you look at the current, headwinds, the so-called headwinds in the market, and the competition or the competitors we have in the markets.
The challenges are acknowledged, and clearly all companies in the IT space are witnessing these challenges. Joseph, if I can take this question to you, uh, what's your outlook as far as the challenging environment is concerned? Because the globe is in a bit of a flux, and with growth headwinds and client confidence a bit shaky, what's the outlook?
So I think you're right, Siddharth. There's a fair bit of uncertainty in the market, and it's a little odd because if you look at some of the economic parameters, they're positive, and they would indicate that there should be a stronger investment environment. But at the same time, I think there's underlying fear and uncertainty, and one of the reasons that's causing this is the geopolitical environment. And as a result, what we are seeing at least is that customers do begin their because I think one thing that at least from conversations with customers that I see very clearly is that the intent and the need to embark on digital transformation, digital initiatives is clearly a must-have for customers. At what pace you do and how you do it is what is at stake out here. And I see quite a few customers starting with discovery or consulting exercise to get a better idea of what are the different areas, use cases, and things that they could do. And then once that's completed, they're picking and choosing rather than, in many cases, picking and choosing rather than going ahead with a complete implementation, which they would have done earlier. There's also another trend we are seeing where once the discovery or consulting phase is completed, there's a gap between that and the implementation phase. So as a result, your sales cycle and your overall revenue realization is getting elongated, and that's what we are seeing in the market. Again, if you look at it from a uh, vertical perspective, right? There are a few verticals which still continue to see a fair bit of demand. If you look at the manufacturing segment, I think they were a little late to digital, so plant automation using more of IoT. Those are things that we are still continuing to see. If you look at edutech, if you're able to find the right areas like workforce development, because multi-skilling, upskilling, and trying to get more people into the job market is something that people are investing in, right? If you're able to get into that area, and we have a couple of customers that we've been able to close in the last 6 to 8 months that have become $1 million customers in this space. So if you're able to find the subsegments and the right kind of service offering, you're able to actually get traction. So that's what we are seeing, and you have to be very targeted rather than broad.
Absolutely, and I think in such times targeting is makes sense. Venkat, how is the project pipeline looking like, and if it's a bit shaky right now, by when do you expect things to stabilize?
So one thing when we are giving guidance of 12%, we have looked at the next 2 quarters for sure, and that assumes that we will more or less do what we have done in the first 2 quarters in the next 2 quarters. So it's about 3.5% in first quarter, 3.6 in the second quarter, and a similar growth trend is what we are trying to replicate in Q3, Q4. While acknowledging that Q3 there are some challenges because of the number of work days, it's a very operational issue. We've got only 59 work days compared to 61 and 62 typically that you have in a quarter. So this quarter, especially given that all holidays are coming on a working day, it may look very small, but it has its impact on revenues of an IT services which bills by the hour. So we have taken all of that into consideration, and also the pipeline that we have from the businesses, and that's the basis on which we've given this guidance of 12% for the rest of the year. But the pipeline number.
Yeah, go ahead. Yeah. Please complete your point.
Yeah. When you say pipeline number, we do not give out something called pipeline, but the indicators that you have to see from that we give out is one, deal wins. So we have signed up 7 new logos. We have signed up 13 and 14 in the last 2 quarters respectively. So there are these logos that are nicely that have been signed up. We have to now build into them, build our business plan into them, build our business growth into them. Second is you can look at our repeat business. It's gone back to the 89-90% levels, repeat business for us. And on top of that, 53% of revenue is coming from customers who have been with us for more than 5 years. So all these, when you take it in conjunction, you realize that the propensity to spend with us continues. Health of the customers are decent. And like Joseph mentioned, you overlay that with the overall economic environment, you get a mix that suggests that we are hopeful of doing this 12%, or we are reasonably confident of doing this 12% guidance while pursuing that inorganic growth to see if we can do anything on top of that 12%.
Okay. What about the verticals that are expected to contribute to future growth? Joseph, you want to take that one?
Sure. Yeah. So, if I look at all of our verticals, and before I got into this call earlier today, I was conversing with all the domain heads that we have, and one of the threads that was common across all, and I have just made some notes while I was talking to them. One of the threads that was common across all of the domains, whether it's BFSI, media entertainment, edutech, high tech, retail, manufacturing, was the opportunities around Gen AI. And as you would have read by now, Siddharth, we announced the formation of a Gen AI business unit. And so this was, a confluence of two, three things that came together. We started investing in Gen AI a year back. It was an initiative started under our CTO. He pulled in a few senior people, and they were sort of figuring out how we could help our customers, look at new revenue streams and optimize their cost using generative AI, various technology, whether it's open source LLMs or OpenAI or Bard. So that's what they were doing, and and then we started engaging with customers earlier in this calendar year, and we realized that there is a huge potential. And so the last few months we've been looking at how to actualize this, and that's where, based on the fact that there's this common thread running across all of the verticals, we decided or industries, we decided to have this as a separate business unit, that would focus on this, would have the responsibility for building the business, get the investments, and also be accountable for delivering results. And it's going to be led by Rajiv and Sridhar, who's our CTO, who's been very deeply involved in this space and was the right person to head this initiative. And so we're very excited about what this would bring to the table, both in terms of direct revenues and influence revenues, because we already see a few new logos that we're about to close. Even though they're working with, they have existing vendors, we're able to break in based on our Gen AI service offerings. So that's what I see broadly. And then in terms of verticals, I talked about manufacturing giving having the scope or potential for digital because they've been a little late. You look at edutech, you have to figure out the subsegment out there. We've looked at workforce development and maybe even K-12 in US, which is seeing investments post COVID. And then in retail, there's a lot of investment around optimization of supply chain and the logistics part of the technology roadmap. So looking at sub-segments within each of the verticals that are that have some industry trend that will necessitate investment. And so we're taking a little bit of a micro approach to how we are approaching each of these industries.
A quick addition to that, what is the size of the revenue opportunity this new SBU is going to target?
So as we speak, Siddharth, we are looking at, it is going to be sizable, right? We've not, and as we speak, Rajiv and Sridhar are working with Venkat and team to put a business plan in place and to put some revenues, investments, costs together. And so we'll have a better idea of what the exact numbers would look like in a few months' time. But the fact that we're having it as a separate business unit indicates that we expect it to give us a significant portion of our revenue in the medium to long term.
You also announced a product and digital engineering services business unit, which will combine the product engineering services and digital business services units. Expand on that. What's the strategy here?
Yeah, so twofold. One is, as we announced the formation of the Gen AI business unit, we see this Gen AI being offering, as I said, that would cut across verticals and therefore cut across both our existing business units of PS and DBS, which is product engineering and digital business services. In the last few years, we've seen more and more of an overlap between the offerings that you have in the product engineering and the digital and the enterprises, because a lot of enterprises are building platforms. They are building, open platforms and using more of open source technologies. And we felt that there's a lot of learning that can be used across. There's a lot of skills that both of these business units had that can be pulled together, and therefore you'll get some efficiencies out of it. And there's a lot of cross-pollination that will allow us to serve our customers better. And that was the driving force behind bringing these two business units together, and to serve our customers better, to extract efficiencies, and and then take GenAI across all of these verticals. So that's the reason why we brought them together. And this is we are looking at this as a product and digital engineering services, because the key part of it is the engineering part of it, right? We're going to continue helping customers engineer their platforms, whether it's on the hardware or on the software side, and that's what we're looking to do with our customers.
Venkat, one of the other sides of your results announcement is hiring, and in a season where most IT companies have dialed back on hiring for obvious reasons, and there's also been a spate of layoffs in the wider tech segment. You seem to be amongst the only few companies which have had a net addition as far as the workforce is concerned. The number may be small, but in these times perhaps is indicative of how things are. 237. Your thoughts on what's happening on the HR front?
Yeah, so you're absolutely right. We are one of the very few companies to show a net headcount addition. It also shows that when we gave out the commitment to the campus joiners, we made sure that we honored them. And that's one reason. But more importantly, while it has affected utilization, our utilization was upwards of 79% the whole of last year. It has retracted or retraced down to 75 to 76% this quarter. We have still gone ahead and done what we had to do, because, like I mentioned, this is a foundation for building a larger, capable organization, and did not want to take any of these immediate shortcuts, which could give you immediate dividends for the quarter, but would not add in terms of what we're trying to do in the longer term. So that's one. But looking into a forecast of headcount, we will have to look as we progress the quarters. We have this, the lever of utilization with us. We have this net count addition, who will now become part billable or fully billable very soon. That will add to our strength, workforce strength. And so to that extent, we'll have to take those into account while we go into the next couple of quarters in terms of hiring.
While you were giving that answer, I was looking at the latest numbers for the rupee, trading at around 83.23, record lows that we have seen on the back of a weaker dollar. And there are some concerns. How significant is rupee volatility as a concern for you going forward?
80% of our inflows are in dollars, Siddharth. So to that extent, devaluing rupee does add in the medium term to our bottom line and our ability to manage costs better. It's a well kept or a not so well kept secret that the IT industry always has been managing a part of its cost increases through rupee devaluation in the medium term. And in the long term, it does help catch up on the cost increases. So that's how it is. It will add to about 0.2, 0.3% of profitability. 1% of rupee devaluation means 0.3, 0.4% improvement in your profitability. Obviously, subject to the hedging policies that each company follows. But we have seen that a percentage decline will add to about 0.3% or 0.4% of our profitability.
All right, that's a fair assessment of your second quarterly performance, and clearly some of the headwinds that we have seen emerge have put some pressure on the entire IT sector, but Happiest Minds holding up in many ways. Joseph, Venkat, thank you very much for your time with us today, viewers. With that, it's a wrap on this conversation. We'll be back with more. Until then, goodbye.
If you like the video, do like, comment, share and subscribe.